Hi everyone, I'm Ara Oghoorian with ACAP Advisors and Accountants, and welcome back to our channel. Right now, everyone is talking about tariffs, China, Doge, or the massive cuts in the federal government. But there's another issue that's about to hit the headlines, and that's the immediate need for some sort of tax reform. So today we're going to talk about the largest tax cut in American history that's in the works for 2025. President Trump is pushing really hard to pass tax legislation this year, which was a big cornerstone of his campaign. In fact, the White House recently posted on X what Trump wants in his final bill. So why now? With so much going on in Washington and across the country, why the rush to have tax reform right now? Well, there are really two reasons. One is a reason I mentioned in a previous video, is that the GOP or the Republican Party essentially has a trifecta. They control the House, the Senate, and the White House, which gives them the ability to pass sweeping tax legislation much faster than if there was a divided Congress. The other reason is the Tax Cuts and Jobs Act that was passed under Trump's first term. That is set to expire at the end of this year. And if that is not renewed or if that is not fixed, then millions of Americans and business owners are going to see their tax rates go up by the end of this year. So now let's go over each of the tax priorities one by one that were outlined by Trump and Congress. Tax priority number one, no tax on tips. Trump made this the centerpiece of his campaign, and in fact, it was so popular that even candidate Harris at the time started using it in her own campaign. Now, the goal here is to give tax relief to service workers. So right now, if you're in a service industry and you earn tips, you pay income tax on those tips, you pay Social Security tax and Medicare tax for every dollar of tip that you earn. But under this new proposal, you would be able to take a 100% deduction of those tips against your income. Now, while this is huge, it's also industry specific. That means we're talking about real tax savings for Uber drivers, Lyft drivers, baristas at coffee shops, restaurant servers, bartenders, hotel staff, and salon workers, and so many others in the personal care and hospitality industries. Tax priority number two, no tax on Social Security. This was another promise by Trump on the campaign trail, but is now part of the proposed tax plan. Right now, Social Security benefits are only tax-free if your income is super low. So if you're single and you earn $25,000 or less, or if you're married and you earn $32,000 or less, then your Social Security benefits are not taxed. So as you can see, that's a very low threshold. But if you earn more than that, then up to 85% of your Social Security benefits could be taxed. But under this new proposal, those income thresholds significantly increase. If you're single, one of the proposals is you can make up to $100,000 a year and not pay tax on your Social Security. And if you're married, you can earn up to $150,000 a year and not pay tax on Social Security. Now, again, those numbers are not finalized, but those are some of the numbers that are being thrown around. But regardless of what it is, it's going to be a meaningful benefit for retirees to be able to keep their Social Security benefits tax-free. It's also important to note that many states, including states like California, already don't tax Social Security benefits. But this would be a game changer on a federal level because potentially millions of Americans who are living off Social Security could earn that living tax-free. Tax priority number three, no tax on overtime pay. Millions of Americans work overtime either because they're trying to make ends meet or they're trying to boost their income because overtime hours pay more than regular hourly wages. But just like tips, overtime hours are also taxed like regular income. You have to pay Social Security tax, Medicare tax, and income tax on every dollar that you earn beyond your regular 40 hours a week. Now, the goal of the new proposal is to give targeted tax relief to these individuals. Now, these are folks who are clocking in and out every day. They're working extra shifts, putting in long hours. And this new proposal is going to eliminate the federal tax on all of that overtime pay. It's called the KEEP Act, short for Keep Every Penny. Now, under this new proposal, any wages earned from overtime pay would be completely excluded from your taxable wages, meaning more money in your pockets and more take-home pay. Now, keep in mind, this is actually not a brand new idea. It was introduced by Congress multiple times over the years, but it's getting more traction right now in 2025 as Trump proposed it on his campaign trail. Tax priority number 4, renewing the Trump tax cuts. Everyone is thinking about what the new tax cuts are going to be and how it's going to affect them or benefit them. But most people don't realize that the existing tax cuts from 2017 under Trump's first term, those are all set to expire at the end of this year unless tax reform is passed. Now, here's a short list of some of those provisions under the Tax Cuts and Jobs Act that are set to expire at the end of this year. The first one is the Tax Cuts and Jobs Act reduced the marginal tax rate for everyone. The 15% was reduced to 12%. The 25% was reduced to 22%, the 28 down to 24, the 33 down to 32. The 35% tax bracket remained the same, but the 39.6%, the top tax bracket, was reduced down to 37%. The Tax Cuts and Jobs Act also increased the standard deduction for all categories. This gave an immediate deduction to millions of Americans who either don't itemize or don't own a home. Now, a quick side note, if you're not familiar with the difference between itemizing and the standard deduction, watch the other video I did where I talk in depth about the differences between the two. So the Tax Cuts and Jobs Act increased the standard deduction for all categories. If you're single, the standard deduction used to be $6,350. Now it's currently $15,000. If you're married filing jointly, the standard deduction was $12,700. Now it's $30,000. If you're doing head of household filing, your standard deduction used to be $9,350. Now it's $22,000. And if you were married filing separately, your standard deduction used to be $6,350. Now it's $15,000. The Tax Cuts and Jobs Act also doubled the child tax credit. It used to be $1,000, now it's $2,000. But the most notable deduction from the Tax Cuts and Jobs Act that affects nearly all of my clients is the Section 199A Qualified Business Income Deduction. It's also known as a QBI deduction. Now, this is targeted especially for small businesses, and it's a generous 20% deduction against your business income. So right now, if you own a business, and let's assume you earn $200,000 a year, you get a $40,000 deduction immediately on your business income. So that means instead of paying tax on $200,000 a year, now you're paying tax on $160,000 a year. Now, if you want more information on the QBI deduction and how it's calculated, watch another video I did where I dig deep into it and give you some very specific examples. The Tax Cuts and Jobs Act also doubled the estate tax exemption, which is a tax you pay on your estate upon your passing. The estate tax exemption was $5 million back in 2017, but now it's $14 million per person. And unless tax reform is passed, that will revert back to its 2017 levels. The Tax Cuts and Jobs Act also allowed businesses to immediately expense 100% of the purchase of new and used equipment. So before the Tax Cuts and Jobs Act, businesses were only allowed to deduct 50% and it was only limited to new equipment. But the Tax Cuts and Jobs Act includes new and used equipment, and it's a 100% deduction. It's also known as a bonus depreciation. So all of these tax cuts are set to expire at the end of this year unless a new tax plan is passed this year, which is why it's so urgent for Congress to act on it this year. Tax priority number 5, adjusting the SALT cap. SALT stands for state and local taxes, and it includes the property taxes you pay. So before 2018, you were able to deduct almost all of your SALT taxes against your federal income. But because of the Tax Cuts and Jobs Act, that severely limited the SALT deduction to a maximum of $10,000 a year. So this hit my clients especially hard who are either in California or New York or other high tax states that have high income taxes or property taxes. Under this new proposal, there's either going to be a complete elimination of the SALT cap limitation, or it's going to severely increase it to $200,000 for married people, married filing jointly, or $100,000 for people who are single. Now, this is going to be a huge tax relief for a lot of people who are disproportionately affected by the SALT cap limitation. Tax priority number 6 is eliminating the special tax breaks for billionaire sports team owners. So one of the more surprising proposals by President Trump is to eliminate what is known as the roster depreciation allowance. This is an allowance or a tax loophole that allows large sports team owners to be able to deduct massive amounts from their purchase price. I should point out that all business owners are allowed to deduct the purchase of equipment or property when they buy a business. This is just simply known as depreciation, and that's a very common practice among all business owners. But business owners are also able to deduct what are known as intangible assets. An intangible asset is something that has value, but you cannot touch. So let's assume that you purchase a restaurant for $1 million, and that $1 million includes the value of the equipment in the restaurant, the tables and chairs, the plates, all those physical assets make up, let's say, $800,000 of your $1 million purchase price. The other $200,000 is made up of the name of the business, the customer loyalty, maybe some recipes that the business has. Those items are called intangible assets. That additional $200,000 you paid for those intangible assets, those value of the name and the recipes, those are intangible assets, and they too could be written off against your income. So this roster depreciation allowance that President Trump wants to eliminate is essentially the ability for these sports team owners to write off these intangible assets against their income. So for example, in the year 2000, Mark Cuban bought the Dallas Mavericks for $285 million. Now, a small part of that $285 million was the value of the physical assets of the Dallas Mavericks. But a big part of that $285 million was the intangible assets. So intangible assets such as the player contracts, franchise rights, media deals, fan loyalty, all those things were intangible assets that Mark Cuban was able to deduct against his personal income. But this loophole is actually not new. It's been around since 1976 when Ted Turner bought the Atlanta Braves for $10 million, and he utilized this rule to be able to deduct the amortization or the intangible assets of the purchase price. Now, Trump's proposal would eliminate this loophole and bring the tax code more in line with economic reality. Tax priority number 7 is closing the carried interest loophole. So this one hits especially hard to private equity, venture capital, and hedge fund firms that really benefit from this carried interest rule. So think of Mitt Romney and Bain Capital. Mitt Romney made most of his money through this carried interest and the favorable tax rates that apply for carried interest. So carried interest is actually the profits that fund managers like hedge funds and venture capital firms make from their investments in these funds. And it's not taxed like regular income tax where you pay regular payroll taxes like Social Security and Medicare. It's taxed like long-term capital gains that has a much lower favorable tax rate. So the Trump administration now wants to change the way that carried interest is taxed and have it taxed like ordinary income, same as wage income that is subject to Social Security and Medicare. Now, under the Tax Cuts and Jobs Act, the Trump administration actually narrowed the eligibility for carried interest. Whereas before, carried interest, if you held that carried interest for 1 year, you got the 20% maximum capital gains tax rate. Under the Tax Cuts and Jobs Act, they made fund managers, hedge fund managers and venture capital firms wait 3 years for them to be eligible for the lower capital gains tax rate. So under the Tax Cuts and Jobs Act, the carried interest rule became more restrictive, but under the new proposal, it's going to completely eliminate the loophole and count all of that as ordinary income. Tax priority number 8 are tax cuts for Made in America products. And this proposal is all about reviving U.S. manufacturing and keeping jobs in the U.S. So under the Tax Cuts and Jobs Act, President Trump at that time in 2017 lowered the corporate tax rate from 35% down to a flat 21%. And that actually is permanent. It's not going to expire at the end of this year. But under the new proposal, Trump wants to go even further and lower that tax rate even lower for companies that manufacture and make products here in the US. The plan is to lower the tax rate even more from 21% down to 15%. But again, it's only for companies that produce their products in the US. Now, a quick side note, this only applies to C corporations. And the reason is because C corporations are double taxed. S corporations have a flow through. So S corporations do not pay federal income tax. The income that an S corporation makes flows through to the owners, and the owners pay tax on that. So this new proposal is only for C corporations. But the plan doesn't stop there. In addition, it also provides heavy incentives for companies that make their products in the US to be able to expense large capital investments immediately versus spreading them out over several years. It also allows them to do the same thing with research and development costs. It allows them to deduct it immediately, especially for research and development that's done in the US versus spreading it out over several years. So together, these proposed changes are designed to fuel domestic production and reward companies that move their production or keep their production in the US. Hey, thanks for watching. As you can see, there's going to be a lot of changes for 2025, and it's going to impact almost everyone, whether if you're a retiree, a business owner, an hourly worker, someone who works overtime. It's going to have an impact on you. What we also know is none of this stuff is finalized, so we don't know what's going to go into the final bill. But I'm going to be keeping track of everything that's going on, and I'm going to continue to promote and do new videos as new information comes out. So I encourage you to please subscribe, like, and share our channel so that way you can stay up to date on what's going on with these new tax law changes. Lastly, I'm Ara Oghoorian with ACAP Advisors and Accountants. Thanks again for watching, and I'll see you next time.